Good evening, dear students. Nice to see most of you. So just let me know, can you hear me? So we have 5 attendees right now. I hope rest of students will join later. So just let me know, can you how you can hear me? So because we are going to start very soon. Thanks. So as I know, most of you have missed the last session during the time changes of the class. So today we have a new topic for finance, and we are going to study about the performance evaluation, the behavioral consideration on the management account and decision making. And then when we will complete it, we are going to repeat our last exercises with their solutions. Because of you, some of you are missed, so I just want to remind you the exercise which was based on the techniques which are analyzing the capital expenditure decisions. Okay, I think that should be all right for you. So some of you asked me about the that is final class. No, this is not final class because we have another topic for the next session, and then the next session will be a last session. After that, we will have the exam, and we are on the next session. We have a last topic. It's a very short topic. And we are going to do some additional exercise, which will be based on the exams exercise. And on the next session, I give you about the exam procedure, how we are going to get it first, what kind of exercise will be on the exams. And we try to have some solution for the same, maybe not the same exercise, very related to the exam exercise. Okay. Yes, I am going to repeat the last class after the new topic. Okay. So we are going to start. So here is we have a chapter 7, which is calls the performance evaluation and the behavioral consideration on the management accounting and decision making. Let's see. So we are going to study about the financial measures in the investment centers. So they are focused on the summary profit-based measures, and which is used to evaluate the performance of the profit centers and the investment center. What kind of measures we have them in the investment decisions? It's called the return on investment, which is we call sometimes shortly ROI, the residual income ROI, and the economic value added, which we call EDA. So this is 3 kinds of measures which are based on the profit. So let's see each of them in details, and let's see their solutions. So here is given to you a formula for the return on investment. So it's used to measure the performance of an investment center. So we are going to take our profit and divide on the invested capital. This is if you would like to see in the percentage, we just multiply on the 100, and we can see our return on investment from the invested capital. So this is a measure first, which help us to measure the performance. any project which you are going to get in the future, or we call like a project or some invested project, or we can call it like some kind of, let's see, like a new idea in the company which you are going to use to make a new production, to replace any equipment, to make an advertisement. This is all about the investment center, all about the project. So here is given to you how we have got the forum from the rate of return, from the return on investment. Let's see. Here is just example shown to you. If you would like, if you know your profit and your invested capital, you're just going to use your formula which is given in the previous slide, right? Just take your profit and divide on the invested capital multiplied on 100. You can see your return on investment in the percentage. But if you have just balance sheet only, you can get your return on sales and multiply on the investment turnover. Then you can get your return on investment. So let's see the next one. What is invested capital itself? This is the assets that the investment center has available to generate its profit. That we know. We studied about in the accounting. You remember? What is the return on sales? As you remember, we studied also about this. It's the percentage of each sales dollar that remains as a profit after all expenses are covered. And the investment turnover, it's the number of sales dollars that generate by every dollar of invested capital. So if you would like to get your return on investment, you should first get your return on sales, which is given to you. Just take your sales and divide on the profit, and you can get your investment turnover from given to you. Then take your profit and divide on invested capital. Then you can get your investment turnover. This is just example given to you how you can get the formula itself. Here is how we can improve our return on investment. This is very interesting and very important question itself. Sorry, I have some kind of questions. So some of you asking me which kind of profit we are talking about right now. Right now we are talking about the common profit. Then after that we can see what is the net profit itself, what is the gross profit itself, and we will study about them another the measures of the profit, and another like let's say the differentiation of the profits. So how we can improve our return on investment? First, we can increase our return on sales, right? How we can get it? Just by increasing the selling price of the product or decrease the expenses. This is the main two kinds of strategies that companies use to increase their returns. They just increase the selling price of the product as you or services, or decrease your expenses. And another way to improve your ROI is the increased investment turnover by the increasing sales revenue or the reducing invested capital. And here is given to you and know that the actions that are taken with the sole purpose of making these ratios more favorable in the short term may have adverse effects on performance in the future years. That means action you are taking, like for example, increasing your selling price or decreasing all expenses or reducing your invested capital. Okay, you can do it in the short term, but in the future will affect your project and will affect your profit in the overall. So let's see, next one. So what kind of advantages we have from the return on investment? First, is very widely used in the measure the performance of divisions and managers. It encourages the manager to focus on profits and the assets required to generate those profits. It promotes an understanding of the relation between the revenues, costs, and assets, right? And can be used to evaluate the relative performance of investment centers, even when those business units are different size. So, ROI, the formula itself, you can use in different kinds of projects first. And second, it's very closely related to profit, the revenues, costs, and assets. It's a measure of the performance. It could be as a measure of the performance invested centers and the managers itself who is getting the project. Well, we have also limitations of the ROI. It encourages the manager to focus on short-term financial performance at the expense of long-term viability and competitiveness. What that means? That's when we use the return on investment measure, it's focused only on the short-term financial performance. That means when we have some kind of short projects and we would like to get the profit fast as we can. It also encourages the manager to defer assets replacement and also discourages the manager from investing in projects which are acceptable from the organization's point of view, and thus it decreases the investment center's ROI. So that is very important also. You must remember that you just can't simply use the formula and to make a decision that you can accept that project or not. You must consider, as you remember, I told you on the last session, you must consider about the other factor that impact the project, which would be as external, which is economical, some political, the market itself, and the internal, which is depends from the company strategy itself, the vision, the company's vision, which is also could be impact from the competitors itself. So let's see the next one. What we have some minimize the behavioral problems of return on investment. So just use the ROI as one of the series of the performance measures that focus on both the short-term and the long-term performance. So this is actually the recommendation for any kind of measure. Just must remember that when you have some kind of project and you have the decision, you must to make a decision on that project. You must to use different kind of the measures which is related to the profit, not one only, for example, as return on investment. It's also considered the alternative ways of measuring the invest capital to minimize the dysfunctional decisions. Of course, that means when you use a different kind of measures to make a decision based on the investment capital investment project, it minimizes the risks about that project. And also use alternative financial measures such as residual income or economic value add. This is as a recommendation given to you. In the additional, you can use these two kind of measures. So I hope you can hear me very well, because some of you can't hear me just chatting to me. If you'd like, I can adjust my volume, but I don't think so that is necessary. Yeah, that should be clear. I won't be very loud. So next, let's see the next one. So here is given to another kind of the measures of the profit. It's a residual income. So given to you by the formula, profit minus the invest capital, we multiply on the input interest rate. You just check your invest capital, multiply on the input interest rate, and deduct from the profit. Gives you some residual income, which means net income. Let's see. What is input interest charge? This is the same as the return rate on the investment. You remember we started on the last session. and also it's based on the organization's cost of capital. And we have some weighted average cost of capital, which is in the international finance we call it VACC. It's the weighted average cost of the funds from all sources of borrowing and equity. As you know, this is about that if you have some invested capital, you also know that the invested capital that could be equity from the shareholders, the money of the companies, and additional it could be the borrowing money from the bank or loans. Yes, some of you asking me the residual income is a net income. The residual income is given to you in the form of this is let's say this is like when you use the return the rate of return. You remember this is the money which we are going to get in the future, but with the present value. Let's say like this. This is the profit which we are going to get in the future, but with the present value. Of course, this would be as a net profit, net income. So let's see the next one. What kind of advantage we have on the residual income? So I have some kind of questions. Ask me about the residual income. Is the net income. As I told you, this is a residual income. This is like you just have your profit and minus you invest capital, right? That the capital you invest in the project, and you can get your let's say we can say that net income, but with the rate of return, that means profit with the value of the present time. Because the profit in the future will be different if we are going to get today, like let's say. So the advantage of residual income first is more likely to promote the goal congruence compared to ROI. Takes account of the organization required rate of return in measuring profit. This is about the value of money. And encourage the investment in projects which yield a positive residual income to the organizations. So if you have some positive residual income, of course, it's encourage the manager to accept that kind of project. So let's see the next one. We have also disadvantages of the residual income. It cannot be used to assess the relative performance of the business that are different sizes, unlike ROI. So it means that we cannot use the residual income for different kinds of projects to compare those projects as we do in the return on investment. And formula is biased in favor of larger businesses, unlike ROI, and can encourage a short-term orientation or the focus as we do in the return on investment. So the residual income, the measure as a return on investment, those are measures which we use in the short-term conditions. When I say this in the short-term condition, I mean in the short-term period of time, when we have a short-term projects up to 5 years, let's see. Let's see the next one. The measuring profit and invest capitals. Here is given to you just definitions of the measures like a total assets. You remember, this is investment measure is responsible for decision about all assets, about the total productive assets. Investment center measures retain the non-productive assets. Total assets less current liabilities. You remember we studied about these measures. The investment center is responsible for decisions about the assets and measure short-term liabilities, and they choose average or all 3-year balances. That means if you would like to get your return on investment or the residual income, you would like to get your results and use the formula, you must check your balance, which is average balance, or the balance which is end of the year by December. You can use the figures and numbers from the balance which is end of year. Also, some kind of I would like to explain to you about just a moment. I lost my idea. Okay, let's see the next one. The asset measurement. We have okay, that previous one. I just want to repeat for you. The investment centers. This is investment centers. Some kind of departments in the companies, like say the financial managers and decision makers, which are running the projects and have the rights to accept or not, or not accept, let's say, the projects. And these are the managers and decision makers. They are responsible to all kind of assets in the company, to the liabilities of the company. Here is as given to you in the definitions. So here is given to you that asset measurement. We can use the asset measurement also in the performance evaluation. Like given to you, advantage of net book value is consistency with the balance sheet that is prepared for external reporting purposes and consistent with the definition of profit. And advantage of gross book value, gross book, you know about the net book value is a net book when we show the profit after made all the expenses. And about the gross book value, the depreciation is arbitrary and should not be allowed to affect the calculations. In the gross book value, in this kind of the balance, we include the depreciation in calculation in the formulas, and the depreciation should be not affect the calculation itself. And because the depreciation, you know, this is depreciation, the futures cost, and the depreciation, the non-current assets may provide the disincentive to invest in new equipment. This also could be affected in the project with the new equipment. So Mr. Akmal asked me about that the net income is coming to the net book value, right? Yes, that is right. When we talk about net book value, we're checking the net income or net profit. When we talk about the gross book value, that means we are taking the income and the profit with the depreciation cost, like this. With the futures cost, we are not going to pay right now, like depreciation, like taxes, like interest pays. So let's see the next one. So here is this is the example given to you. What is the net book value? What is the gross book value? Let's see. Increase in ROI over the time using the net and the gross book value. Let's see, we have an acquisition cost of the equipment. This is the invest capital, which is equal to $500,000 US. Okay, we're going to remark for you. Here, this is our invested capital, right? The acquisition cost. Useful life of the equipment is given to you 5 years. If you would like to calculate your depreciation, the salvage value at the end of useful life is 0. That means we are not declining 100,000 each year. If we use the profit generated by assets before deducting the depreciation, annual profit generated by the assets, it will be 150,000 US dollars. And based on the box, you can see we have a profit before depreciation. Each year is 150,000. So we invested. That means we invested 500,000 US dollars in the project to buy a new equipment, right? The equipment we are going to use 5 years. That means the project will be during the 5 years, right? Given to you the depreciation cost and how much profit we can get there from our project. So given to you the profit before the depreciation would be 150 each year, right? In total will be 750,000, right? Our annual depreciation given to you minus 100,000 every year, right? This is, I think you do understand. The profit after the depreciation is 50,000 each year, right? That means 150 minus 100 depreciation, and we can get our net profit 50,000. So next one, average net book value. Average net book value here is given to you 450. That means we invested 500,000 and minus 50 our profit, and after that it shows you by the formula listed here is after calculation. First year is we have invested capital which would be equal to 450. Next one, 2 years is 350 our cost only. The third year will give us 250. The year number 4 is 150, and the last the 5th year is 50,000 costs from the project only. So given to you a return on investment based on the net book value. So this is already after calculation given to you the results. You remember the formula is we should take our profit, which is a net profit, and divide on our invested capital. That means you take the 50 net profit and divide on your invested capital, which is here is given to as the average net book value. Then you can get the return on investment. Why is the okay? Some of you ask me the question why the average net book value is decreasing each year. This one is a decreasing each year. That means because it's our invested capital. Why is decreasing? Because we are generating profit from our capital, right? And you just when we generate the profit, you just should to add from your invested capital. Then you can get this kind of results. Like from the first year, you will get the profit 50,000. That means 500 minus 50, you'll get the overall cost from the project 450 only. The second year, it will be another 50 and 100. You minus the 100 thousands of your profits from the invested capital. And the next one is given to average gross book value. This is average gross book value. As you know, this is the money we have invested in the capital, in the project. That means that shows just the historical cost of the project. And given to you the return on investment based on the gross book value. Why is it 10%? This is because based on the formula of the return on investment, we should take our profit, which is 50,000, and divide on our average gross book value 500 and multiply on 100, and then we can get 10%. if you didn't understand, I just will type for you based on the use your formula which are given to you in the slides on the return on investment. Which is you remember the profit from the invest capital and divide on the invest capital and multiply on 100 if you would like to get in the percentage, right? So this is you remember that formula. So if based on this formula we are going to use our numbers from the box, like profit. What is the profit? Profit is 50,000, right? And divide based on the formula invest capital. If it's gross book value, the historical invest capital is 500,000. Divide on the 500,000 and multiply on the 100 to get in the percentage return on investment. Then you will get the 10%, right? So I just have typed to you. This is how we get the return on investment based on the gross book value. This is the gross book value. If you wanna get your net book value based on the formula, same things. You do same things. You take your profit 50,000 and divide on the average net book value, which is for the first year is 450,000, right? And multiply on 100, then you will get the answer 11.1%. This is for the first year. Just typing for you. Okay. And then next, second, third year, you use the same formula with the different kinds of numbers. The profit remains same, 50,000. As you can see, the second year, third, fourth, and fifth years, and the average net book value will be different. Will change because it's a net book value. It's the net book value. That means the invest capital minus profit, and we'll get 450 for the first year. Second year will be 350, and so on. So. Okay, so let's see the next one. And here is given to you the marks. Okay, you didn't understand how we can get the 450,000. You see, the average net book value is the average of the beginning and the ending balance for the year in the net book value. For example, for the first year, take your beginning year, which is 500,000 plus the ending year is 400,000 and divide on the 2. You'll get the 450 average net book value. The 500,000, you remember, this is the invest capital. And what is the 400? This is invested capital after depreciation, which is depreciation equal to 100,000. 500 minus 100 will be 400, okay? You do understand, yes? Okay, we have done this box. Let's see the next one. The measuring profit. How we can measure the profit? The profit measure controlled by the investment center manager. It's usually when the focus is performance of the manager, encourage the manager to focus on profit that they control, and motivate. It has some motivational impact. And profit measure attributable to investment center. To calculate the investment center, in 2 words, this means that the manager itself responsible for the return on investment of the company, for the profit. And we use some kind of motivational the reward system also to motivate our managers. Let's see the next one. Okay, here is given to you the various definition of the profit. We have, we have two kinds of the profits that we call the net profit or the gross profit, right? Let's see another definitions as given to you in the box. For example, we have some sales revenue. It's around 9 million. We have some variable cost, and what kind of profit we can get from after our variable expenses. First is the divisional contribution margin, is the fixed expenses controlled by the investment center managers. First is the divisional contribution margin, which is equal to 5.2 million, right? Then second one, we have a profit margin, which is controlled by the investment center. We get it from when we deduct the fixed assets, which is controlled by the investment center manager in the first lines. The third is the profit margin, which is attributable to investment center. It's all common fixed expenses allocated from the corporate headquarters. We have the fourth, investment center profit before interest and taxes. You remember, this is the same as the income statement. You remember, we prepared the income statement. We got some gross profit, that sales minus expense, right? You remember, and then we get the net profit after deducting all the depreciation, taxes, interest. So this is same as we do with the investment capital project. The fifth is the investment center profit before taxes. Then we deduct our taxes, which is 700,000, and after that we can get our investment center net profit. This is the net profit after all made expenses, which is includes the expenses, which includes the depreciation, the taxes, the interest, and all variable expenses too also. So this is, I think that box clear, right? Let's see the next one. So we have some also measures of the shareholder value. So before we looked at the measures of the profits, and right now we are going to see our measures of the shareholder value. So shareholder value is we use to improve the worth of the business from the shareholder's perspective, right? It's value-based management, also using the shareholder value analysis to manage a business. So we use the shareholder value measure to analyze our business itself. The framework is also as a framework for making the key business decisions that add economic value to the business. Economic value, that means this measure will increase the level of their companies in the market. And also it consists of the four aspects, which is valuation, strategy, finance, and corporate governance. So shareholder value, this is also includes this kind of aspects. I think you have studied in the strategy classes. You should study about that. That is include the valuation, strategy, finance, and corporate governance. Okay. What is evaluation? It's a discount cash flows, which is usually used to measure the value. The future cash flows of the business are discount taking into account the risk with those cash flow. That means which we use in the return on investment. The future cash flow at the present time. Okay. The value drivers are the activities or actions that create the value for the business. What kind? They include the spread, the growth, the sustainability of the business, and cost of the capital. strategy, has a substantial and continuing impact on the value of the business itself. Yes, that's true. Overall, the company strategy has a direct impact on the value of the business. The financial policies will influence the value creation too, and corporate governance is involved select and implement systems that contribute the value creation. This is all the rules and policies that are written for the businesses. They are also affect the company's profits, the shareholder value, and profits too. Okay. What is the economic value added? EVA we call it. This is also the measure of the shareholder value. It's a measure of the value created over a single accounting period. The spread between the return generated by them. Let's see the formula. We should take our net operating profit after tax, which is the net itself, and minus the capital employed, which means the capital investing capital, and multiply on the weighted average cost of capital. Weighted average cost of capital, this is same as the rate of return. You remember? We talk about that. So this formula seems same with the residual income, but here is we use our net operating profit after tax. In the residual income, we have used the gross profit in the first line, gross profit. Here is we use the net profit. Okay. After that, all are same. Capital employed and multiple on the weighted average cost of capital as a return on investment. Let's see the next one. Okay, what we have some another kind of weighted average cost of capital that is given to you. Definitions in detail is used in the calculation of EVA and residual income. To improve our EVA, we improve the profitability without the employing additional capital. We can borrow the additional funds when profits earned are more than the cost of borrowing, and pay off debt by selling the assets. So that means to improve your EVA, you can borrow some additional kind of funds. What we have also limitations of the EVA is potential for the manipulation and short-term orientation, same as the return on investment. They are all focused on the short-term orientation. Okay, some of you ask me what is capital employed. This is capital employed. That means the capital you have in the company. It will be the equity, the shareholders' money, and plus some borrowing money. For example, some loan credits from the bank. Okay, this is in total will be in the summary will be the capital employed. Okay. So let's see the next one. We have some shareholder value added. As given to you by the formula, is corporate value minus the market value of debt. What is the corporate value? Is the present value of the future cash flows. You remember what is the present value of the future cash flows? This is when we use our return on investment, the return rate. Alright? And residual value is the value of the firm at the end of the forecast period. So first, if you would like to get your shareholder value added, check your corporate value. Corporate value is your cash flow from the project with the present value. When you do calculation on the return rate, you remember the formula of the DCFA, the discount rate, and minus the market value of the debts. Your debts, you have some kind of debts in the company, and the market value of those debts. Okay, let's see the next one. So, okay, to make evaluation of the performance of the managers' investment centers and the managers itself. We also can use the reward systems to motivate them. You remember we studied the reward system in the human resource management? You remember about just we are going to just repeat it little in the short slides. The reward system is the processes, the practices, and systems which are used to provide the levels of pay and benefits to employees, right? We use the motivation in the reward system. That is a process that accounts for individuals' intentions, direction, and the persistence of the efforts towards the attaining goals of the company. We have some, of course, any company has a special goals. We use the motivation to get our goals. Intrinsic rewards is an intangible arise from the positive experience of the being associated with the performing well. Is like you remember is non-financial rewards we call it in the HRM. And the extrinsic rewards is given to employees from an external sources. This is some kind of financial rewards which is given to the employees, some additional bonuses or premiums or something else. And theories of motivation, you remember that we studied about what is the Herzberg theory of motivation. If you would like, I can repeat for you. The Herzberg theory of work motivation includes the two kinds of factors, which is first hygiene factors, which affects on the employees' results, and the motivators, which also can affect the employees' results. What is a hygiene factor? The factors that provide the setting for encouraging employee motivation, but do not themselves motivate employees. It's like working conditions of the firms, the wage levels, the salary levels, the rules and regulation of the company, the relationship between the colleagues, and the top manager, let's say, and job security also could be as the hygiene factors. That the factors, let's say, which is decrease the potential working of the staff. And motivator is the factor that relate to the job content and which provide employee motivation, which is motivate people itself. This is achievement, the recognition, the nature of the work itself, the responsibility, the opportunities for the personal growth, like let's say the training and development programs. Yes. Let's see the next one. Also, as one given to example, expectancy theory, we can use to make our evaluation of the performance of the managers. Like employee motivation is the result of the strength of the relationship between the expectancy, instrumentality, and balance. What this means? The expectancy is the perception that effort will lead to a certain performance. It's like you're expecting to get some salary or some additional bonuses. This is your expectancy, which then affects your performance. The instrumentality, the perception that performance will lead to desired outcome. That means you do some project, you do some performance, you will get the good performance, then you'll get the recognition for this performance. The value is the attractiveness of the reward. Like any company will provide some kind of rewards for the staff. The rewards is like financial rewards, like bonuses, additional salary, for example, the increase in the salary. It could be like non-financial, like providing a car for the staff. Let's say the medical insurance, the free medical insurance, or some kind of a trip which is provided to the staff, or training and development programs which provide a company for the staff. So the attractiveness of this reward, that means how attractive this reward for the staff. All people are different, right? Some of us likes different kinds of rewards, so you must be able to indicate what kind of rewards are suitable for this staff, for this employee. So, okay, the motivation theories need to be considered by the managers when they are designing performance evaluation and reward systems. Okay, so here is also important that the human resource management, the department, also will be linked and will be has like, let's say, the closely contribution with the investment centers, with the managers, and with the decision makers of the projects. They should be all contributed. The all departments actually are contributed, but HRM, let's say the human resource management, the human resource department, with the investment center, which is main center in the company, will be closely contribute in the businesses, in the making any kind of change in the company, or in the motivating the staff in the overall. So, okay, let's see the next one. We have another kind of performance-related reward systems. Just given to you as example, incentive compensation schemes. They link employee rewards for achieving or exceeding some performance targets. This is, this is like when you link the staff's, his or hers, the performance with the targets of the company, and with the rewards, with the three links would be. We have some individual incentive plans, like individuals are rewarded by achieving the individual performance targets. Its subjective criteria may also be used, common at the senior levels of the organization. So when we can use the individual incentive plans for the top manager in the company to increase his performance in the investment center. So let's say the next one. We have some profit sharing plans also. This is when you provide opportunity for your staff to buy the shares. Yes, some companies, they can provide this kind of let's say like as rewards. Yes, when the company sells its shares to its staff. So the cash bonus are paid to each employee based on the specific percentage of the company's profit, that you will get some interest from the shares, and does not tie the individual effort to individual rewards. What is employee share plans? Also, we have employee share plans, like provide employees with the right to purchase the shares, as I told you right now, in their company at a specified price at some specified future time. That means when we say the specified price, actually mostly is given a discounted price for the staff, and specified future time that maybe it's, could be given some period when you can buy the shares in your company, not like you say you have some idea to buy today. The company, the shareholders, they said this is the time when they are sell the shares. Okay, they commonly used for senior managers and sometimes more junior managers and employees, and considered to encourage the goal congruence. That means, which is commonly used for senior managers, that means the shares can buy the like top managers, the senior manager or head or CEO, like junior managers. And about it's encourage also the goals of the company. Of course, when you buy the shares from your company, you like to get the performance very good, to get the results from your job. You will work very hard. You will get the good results. Also to increase the value of your shares, and to get the interest, the high interest at the end of the year. Yes, this is all are contribute in links with together. Okay, next one, the gain sharing. The cash bonus are distributed to employees when the performance of the company, of the segment of the company, exceeds some performance target. What that means? Okay, we have some cash bonuses. They are also motivate people. That's in 2 words. And team-based incentive schemes. You remember before we talked about the individual schemes. Now is the team-based. Individuals are rated based on their work. Team exceeds certain performance targets. Intend to encourage the teamwork and cooperation between employees. In some departments, the teamwork is the best solution. It does not tie the individual effort to individual arrival. So it's like you can use 2 kinds of systems, the labor system in the company: the teamwork and the individual. All those individuals can be contributed in the teamwork project, and also you can give some additional individual targets for those people to encourage them, let's say, to motivate them. Let's see the next one. The group score is just given to you. The group versus individual performance. Which is the best? Which system is the best for the staff? Okay, the identification with the group. The first is the group. Is concerned the following issues: identification with the group, equity among employees. We have some equity. It has a competitiveness between employees. Of course, the employees will compete among this group. The related individual effort to reward. That means maybe some individuals have some different kind of efforts to get the rewards. The reward only good performance. And we have some time of incentive payments can be crucial to achieve the desired outcomes. The more frequent reviews may help ensure the continuous motivation. Okay, with all those things you do understand, and you should remember in the human resource management subject. Okay, any questions so far related to the performance evaluation of the decision makers? About the measures of the profits, about the measures of the shareholder value. Any questions so far? If no, we have another half hour. We can move to our practical exercises. Just repeat the last practical exercises. 16. Next topic will be decision making under condition of the risk and uncertainty. This will be the last topic for the finance. Then we complete the finance in overall, and after that will be exam. So any questions? No. I think that is this topic was based on the some theoretic very important things that you should know. How the profit will affect the manager's performance. This is about in the 2 words. How we can evaluate the manager's performance by the profits measures, which is residual income, which is the net income, which is return on investment, and the EVA, which is shareholder value, evaluation of the shareholders' value. Yeah, I think this subject is not so hard, as you can see that's clear. So then we can move to our practical exercise to repeat our last sessions. As I know most of you missed it, so just going to remind for you. Okay, the practical exercise was based on the techniques that analyzing the capital expenditure proposal, that analyzing the project itself. Yes, let's see. You remember the exercise number 1, given to you the project analysis. Assume that you are evaluating the following 3 mutually exclusive projects. So you have 3 kinds of projects. It's A, B, and C. The project given to you for 3 years. Sorry. So cost of the project for the ABC all are same, which is equal to 6,800. But the profits are different. As you can see, the generated profits are different for all the 3 projects. The first is year where we get 0 profit, no any profits. For the second, same, no profit. and at the third year we will get the profit, which is equal to 12,920. It's around 2 times, yes. For the project B, we are generating the profit, some average value each year is 3,740 by each year, right? And the project C, for the first year, we are generating profit 2,040. The second year, 3,400, and last year, it's 6,568. Okay, so we have that's clear, 3 projects with the same costs, but with a different kind generate profits. Let's see the next one. So the question was, so we should complete the following the boxes. First, the payback period, ARR, which is average return, NPV at 10%, NPV at 15%, and I include the IRR, which will explain to you at the end of this presentation. And the project B given to you, just let's see the project B. If 10% is required to do, which project is the preferred? Okay. I've got the value from the payback period for the project A is at 2.53. That means we need 2.53 years to get our money back, right? The project B, we need 1.82 years, around 2 years to get our investments back. And same as we see is a 2.21 years, sorry. ARR is for the A project, the profit we are generating, average profit that we are generating each year is 63.3%. For the project B is 55%, and the project C is 58.86%. Okay, and then we should rank it. You remember? Okay, for the payback period first. As you remember, the shortest period is the best project, right? The shortest we have a period for the project B. We rank as a number 1. The next one will be C, is ranked by 2, and the last is the project A. We rank by 3. It takes last place. For the ARR, is the highest is the best. The highest profit we generate from the investment capital is the best from the project. First is the highest. Here is the project A, right? Then comes with the project B or C, sorry, and the B is the last place. Right now, I just want to explain to you the box first, and then we'll give you the calculation in details. Okay? NPV at 10%. For the project A is 2,907. For the project B is 2,500, and for the project C is around 2,800. So for the NPV at 10%, the NPV is the net present value. Is the highest. The highest value is the best project, which is highest here. Is the project A first comes, next one project C, and last is the project B, right? And NPV at 15%. We do calculation. After that, we have got from the project A is 1,700, the project B 1,740, and C is 1,866. So from this kind of perspective, we have ranks for the first one is the project C, second B, and the last is the project A. So, and ARR I am going to explain to you later. So, give a note here is, as you can see, at the NPV with a different kind of percentage, we have a different ranks. Can you see it? Why is it different? We are going to get the answer after our calculations. because you must remember, if you use different kind of first, the ranks are all are different. You can't find the same ranks from our measures like payback period era and NPV at 10% or NPV at 15%. That means you can, if you have a three kind projects to choose the one, you can make a different decisions. If you use some of these kind of measures, if you use the payback period, of course you will choose the project B. Yes, because it has the shortest period money. If you use ARR only to choose your project, you choose the project A, right? And with the NPV, same things. So you must consider about this analysis when you use a different measures. You also can get a different kind of answers. So the question B asks you, if the 10% is the required return, which is the project is preferred, with 10% at the NPV. Given to you answer that at the 10% project A is preferred because it has the highest NPV, right? At the NPV, the highest is the best project. As you can see, here is the NPV at 10%. The best project is the A. Let's see the next one. Right now we are going to see the calculation in details. Okay, sorry, so I have some questions. Okay, some of you ask me, can we have some quick review of some topics before the exams? Okay, you know that we have we have many topics and they are very huge. Just let me know which topics, which calculation you would like to repeat, because we can't repeat overall. Okay, and some of you suggest that about the IRR and NPV. That's okay. We can do some additional exercise based on these measures. Okay, let's see first the calculations of these measures, and then we can get the answer which is project is best for you or for me or for the company itself. Let's see. Okay, when we do the calculation for the payback period, you remember formula? You should take initial investment, the capital investment, and divide on the annual cash flow. From the project A, we have got the 2.53 years. In the project B is 182 years. The average, you remember, you will check your average, and which is average. What that means? You take your investment, which is equal to 6,800, and divide on the average cash flow. Here is 3,714. In the project C, we don't have some average profit. You remember, because each year we generate different profits. So we do calculation like this. First, take your profit from the first year, add to the second year, and deduct it from the invested capital. You will get the value which is equal to 1,360. This is value you need to return your to close your costs of the investment, and that means we have we need 2 years, and from the third years we need 0.21 years, around 2 months only, that we should take the value that we need to close our investment cost, which is 1,360, and divide on our invested capital, which is divide on our the profit which is generated from the year 3 is the 6,568. So I think you know how to make calculation with the payback period. Okay, you do remember that this formula is based on the average profits which you generate from each year. But when you generate a different kind of profits by the year, you should do calculation first, as in example C. Okay? Okay, it shouldn't be difficult, because when you do this calculation, you should use the math logics, like is 1 and 2, the 2 years is not enough to close your investment, then you should use the profits from the last year, let's say. But how to get the profit from the last year? You should take the value that we need to close your investment, which is 1,360, and divide on the profit, on the overall profit from the last year, which is 6,568, right? And then you will get answer, which is 0.21 months. This is like around 2 months. That means you need 2 years plus 21, 0.21, which is equal to 2 months. Okay, let's see the next one. Any questions so far for the payback period? Because actually it shouldn't be complicated. It's complicated when you don't have some average profits for the year. Like in the project B, you see, it's simple. Take your investment, divide on the average profit, you will get your answer payback period. Yes? But when we do calculation in the project A and C, we use the different calculation. For the first, we should to identify how many years we need to close our investment costs. So any questions? Some of you asked me some questions like, what is the average of the year 3? Okay, listen to me. The formula given to you right now in the presentation, you use when you have some average cash flow. That means when you get the average profit from your project. Like every year, I will get 1,000. It remains same, and you can just use your formula as given to you. But when you have different profits, which you will get in the year 1st, year 2nd, and so on, you should first to see how much you invested and deduct it from the profits 1st year. After that, deduct it 2nd year. If you are not having enough money, you will get the last year. But you can't get the last year the whole value. And to know how much you need from the last year, which is 3rd year, you check the amount that you need for the 1,360 and divide on the profit from the last year, 6,000. And then you will get how many months you need to close your course in this 3rd year. Okay? Okay, let's some of you asked me about the payback period. Let's see the rest of other measures, then we're back to the payback period, okay? How we do the ARR, how we do calculation for the average annual profit from the project. you see, you check your average annual profit from the project and divide on the initial investment. Seems as this formula vice versa to the payback period, yes? But this is in the percentage. You multiply on the 100. So first year, to get the average profit from the project A. You remember, for the first, second years we have no any profits. It comes with zero money, right? We have only in the last year profit, which is equal to 12,000. You deduct on the 3, which means 3 years. Then you will get the average profit over the 3 years, which is equal to 4,306. Okay? And then based on this formula error, we check the average our profit, 4,306, and divide on our investments, which is 6,800. Multiply on 100, we'll get the answer that the ARR for the project A is 63.3%. That means, like every year, you'll get the 63.3% of the profit from the project. In the project B, we have already average. We won't calculate because we already have an average profit for the project B is 3,740, and divide on the investment, multiply 100, we will get that we can get the 55% of the profit each year from the project B. Okay, and with the C is same. You remember we have to check average profit from the project C. We should get our average profit first. Just add all the profits together for the 3 years and divide on the 3. You'll get the average value, right? It's a 4,002. Then you, based on the formula, check your 4,002 average profit and divide on the investment. You multiply 100, you will get the 58.86% of the profit for the project C. Okay? But you see, when we do calculation for the ARR, which is average annual profit from the project, we should take only average profits. We can do calculation by ourselves. Like if it's the profits are different, just check by the mass average value. But when you calculate the payback period, you can't do this. You can't take your average like here is given to you. If you have a different profits for the projects by each year. Okay. Any questions for the ARR? I think the ARR is a simple formula, right? So if no question, we are going to move. NPV. You remember given to you reminder of the formula. The NPV is method which is used for evaluating the desirability of the investment of project. The net present value. Here is given to you formula. It's a formula based on the last the presentation when we study about the NPV itself. I won't explain because I did it on the last classes. Just want to explain to you calculation itself. Oh, okay, the diligence rule for the NPV, you remember, if it's positive, the project is acceptable. If the NPV comes with a negative value, you should reject that project. Okay, here is given a formula, and let's see the calculation NPV by the 10%. Okay, first, the project A. Based on the formula, we'll get the NPV 2,907. You remember this is all based on the formulas. Check you calculate your present value. Should check your the profit. Here is given to 12,920. Divide on the given for you 1 plus 0.10 is a 10% itself, and the 3 is that means that this is the profit from the year 3, from the last year, and you will get your present value. The present profit means present profit from this project. And then you should deduct it from the investment. Here is we deduct it, and we'll get the positive net present value, which is equal to 2,907. That means you will get the net profit. This is actually net profit of the project A. Okay, in the simple words, is the net profit of the project A. The net profit of the project B, here is given after calculation, is 2,500. You do calculation first. You should calculate the present value for the first year. For the first year, at the 10% is based on the formula 3,400. Second year 3,090, and the last year 2,809. And then you should add all these present values together and deduct from the investment. Then you will get the net profit of this project, which means net present value of this project, and it's 2,500. Okay. And the last, for the project C, you can see that the present profit from the first year is 1,854. For the second year, 2,809, and for the third year is 4,932. Of course, all our values are decreased because we do discounted cash flow. We do calculation with discount cash flow at the 10%. And then, based on the formula, we do calculation. We should add all your profits together and deduct from your investment. You will get your net present value, your net profit from the project C, which is equal to around 2,800. Yes. Okay, some of you ask me, yes, that X bar is a year. Okay. Okay, do you understand the NPV at 10%? How we do calculation for the NPV? All are based based on the formula. First, you do calculation. You do calculation of the cash flow by the present value at 10% for the first year, second year, and third year. Then you should all add it together. Just take a summary and deduct it from your investment. After that, you will get your net present value, which means net profit of the project. Okay? If it's positive, that means the project is acceptable. Okay, let's see the next one. The NPV at 15%, we do same things. Here is, I just changed the, here is this kind of, you see the 0.15, that means 15%. I made a correction with these numbers. Then of course you will get the different kind of answers as you see. For the A is 1,700 NPV. For the project B is 1,740. This is same as the NPV. The formula and calculation we use the same as we do at the NPV 10%. But just you should change your return, which is R, and put it at 0.15, which means 15%. Okay? All of the rest are the same. Of course, you will get the different answers. Then let's see that we have exercise number 2 for the calculation of the net present value. So here is given to you that 2 years ago, a new product capital project was approved for 150 million based upon the cash flows listed below. And calculate the net present value for the original proposal at an 18% of the discount rate. So this is the net present value of the 18%. Before we have done for the different exercise, we have done the 10% and 15. Now we do at 18. But we have a different cash flow because this is a different exercise, okay? Let's see calculation. Here is For the first year, the present value is 3.3 million. For the second year after calculation is 28.7 million. You see, I have changed 0.18. That means 18%. And the NPV at the 18%. For the year 3, we have 36.5 million. For the fourth year, the present value is 39.3 million. I just round it. You can do, of course, you can do calculation in details, but you can round it also. 100. The fifth year is present value 42.2 million. This is present value of the future cash flow. Okay. Investment capital is 150. So, based on the steps to calculate the NPV, you should add all your NPVs together in the summary and deduct from the investment. Then you will get your net present value, which is equal to 6 million of US dollars. Is a positive, that means the project is acceptable, and after the project you will get your net profit. That means you will close your cost, the invested cost for the project, and in the additional you will get a profit which will be 6 million. Okay. So any questions so far to the exercise number 2? Is the NPV calculation, but by 18% with the cash flow given to you right here in the slides. It's okay, yeah? Let's see the IRR, the internal rate of return. You remember at the past presentations, I promise you to explain the IRR in the practical exercise. Here is the IRR is a discount rate at which the NPV for a project equals to 0. And this rate means that the present value of the cash flow for the project would be equal to present value of its outflows. The IRR is a break-even discount rate and is found by trial and error. Just remember one thing, that the internal rate of return, or IRR, is a discount rate where the NPV, the net present value, equals to 0. That means no any profits from the project at the end, net present value. Let's see the calculation. Here is given to you formula. Same formula as the NPV. You can see this is the same formula as the NPV, but where is the NPV equals to 0? And the question is, what is the rate of this return? We should find the R. What kind of rate of return will be to get the NPV at 0? And as I told you, we can find it by the trials and errors. That means we try some different kind of returns, different numbers of returns to get our NPV at 0. Okay, let's see the calculation. Okay, calculation now given to you. Okay, sorry. To calculate your IRR, like we use some trials. Means we try some different return, the rates of returns to get our NPV at 0. And the simple way to use the financial calculators to get IRR. For the IRR given to you, this one link. Let's see this link. You can go for this link, and in this link you can find the formula. The calculator for IRR. Just wanna copy for you for your charts. Just now. So, if you would like to get some additional exercise based on the ARR, IRR, and the NPV, we can do it on the next on the next session. Okay, I will prepare for you some additional exercises. Okay. So go to this link and you will find the calculators for IRR. So here is given to you. You see that you can download the net present value table for calculating the present value of an investment, or you can do it manually. You can see the financial use the financial calculator for IRR. And the next one, the financial exercise on NPV IRR. This is some additional exercises for you. We do on the next session. You can try to do at your homework, at your home, this financial exercise on the NPV and IRR. Just a moment. We'll try for you the links. So you can try do it yourself and send to me what you have got. And we can do at additional, we can get the correct answer on the next sessions, okay? I can see that most of you need some additional exercise, the classes based on the exercises. But you go to these links and try to do the exercise by yourself. And then when you do some practice, not by one like we have done on the sessions, you do in your home 2-3 times, then you'll be able to understand the calculation more clearly, let's say, like this. Okay. Try to review the last presentation based on the IRR and NPV. Try to understand the formula itself and do some practice. Just try. If it's correct, if you do some correct solution, that is very good. If it's not bad because you tried. You try some practices yourself. Anyway, it will help you to understand better than you want to anything, okay? So because we have some 10 classes only, but this is the class number 11. The next one, we are checking already some additional classes for the practical exercises. Of course, I know that it's very difficult to explain you the practical exercise online, like I do right now with the presentation. It's not like if you are studied at the university. For example, maybe you have more understandable view compared to online study. But you can do understand, of course, if you do your own practice. Okay, so that's all. So some of you asked me about the exams. I'm not going to tell you about the exams right now. What it's include, but you must remember it includes IRR, also the NPV, ARR. All these measures will include. In addition, the ratios. You remember we have done calculation with the ratios. Ratios will include the balance sheet, also the question about the balance sheet, how to prepare them, the questions about the income statement, also about the depreciation, calculation of depreciation, what we have done in overall for the finance. The exam question will include all those topics. And you have to review all the topics presentation yourself. But in the classes we do only the main let's say important things, the important practice exercise that you didn't understand. Okay, or you need some additional knowledge for them. Yeah, that's good. Some of you say that if I come to Dubai, MBA come. Because actually, first I'm too far from Dubai. Right now I'm in Europe. It's impossible to come for me because I have my business here. I have my family. Can't leave it. Very busy with them. So thanks a lot. If any questions, just email to me. Mm, I'm going to send you this presentation after class. Okay, and try to see these additional exercises by this link. You see? Look at this link, the last link. Okay, thanks a lot. Have a good time. I hope you joined the class. Any questions so far, just email to me individually. I try to explain you maybe another time. Like, if you would like to have some additional practice, maybe we do like individually, try on Skype or something else, or by email, like that. Okay? Okay, thanks a lot. Have to say you goodbye.